Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Life Liberated podcast. Now, on to the show.
Hello and welcome to Live Life Liberated with the team from Centura Wealth Advisory. Joining me now, Kyle Malmstrom, and he has a special guest. First, we'll talk to Kyle. What topic are you discussing today?
RJ, thanks for having me. Today we're talking about kind of the ins and outs of grantor trusts and non-grantor trusts.
Excellent. And you have a special guest, so why don't you introduce your guest?
Yeah, returning guest Adam Buchwalter from Wilson Elser. How you doing, Adam?
I'm good, Kyle. Thank you for having me.
Thanks for joining. Today, ladies and gentlemen, what we're going to be talking about today is really focused around income and estate tax planning strategies and solutions. And if you've ever done any to this type of planning, or if you've ever talked to anybody about it, oftentimes somebody introduced or talked to you about a concept about an irrevocable trust of some nature. And so today we're going to break down kind of the two food groups of irrevocable trusts, grantor trusts and non-grantor trusts, kind of walk through some of the pros and cons of each of them. We got what I would call a potential match lit in terms of the amount of time we may have available to do one of them. And then we're going to just have a conversation here with Adam, talking about pros and cons and get down into it. So Adam, how you doing?
I'm good. So we're really going back to basics on grantor versus non-grantor status.
Yeah, a little bit about back to basics. There is some nuance on the non-grantor stuff I want to get towards the end of this podcast, but as you know, Adam, I think we'd be doing everyone a disservice if we didn't talk about grantor trusts and the impetus to potentially consider one because of our pending election coming up here.
Of course. So, I mean, getting back to basics, very broadly speaking, when you talk about a trust for income tax purposes, it comes in two flavors, a grantor trust or a non-grantor trust. Both types of trust can be structured so the assets and the value is outside of one's taxable estate. But for income tax purposes, a grantor trust is, in essence, invisible to the grantor. All of the income of the trust would get picked up on the grantor's personal income tax return, and the grantor would pay the tax associated with the trust. A non-grantor trust is exactly the opposite. The trust itself is the taxpayer. It has its own tax ID number, and it will file its own income tax return to report all the income and deductions of the trust.
That's a great explanation. Just real quick, that can reside in any of the states, right? Doesn't matter?
Correct.
So the grantor trust, we're going to pick up the tax, and the non-grantor trust picks up his own tax.
In a nutshell, that's the difference.
Perfect. With that in mind, from a planning perspective, there's any number of a couple of dozen acronyms that get thrown around with each of those types of trusts, from intentionally defective grantor trust to CLAT to CRUT to you name it. There's a truckload of them. And so those trusts typically either meet income, estate, generation skipping trust, asset protection, or charitable goals is typically the way we design it. And so Adam and I have had the pleasure of working together on multiple cases here. And so we're going to dissect these a little bit more, if you don't mind. So, Adam, when it comes to a grantor trust, well, what specifies what the difference between a grantor trust and a non-grantor trust is? Let's just start there.
Well, the real difference is the taxation of the two. As I said, the grantor trust, all of the income is reported by the grantor of the trust, who will pick up the tax, who will pick up the income and pay the tax, and the non-grantor trust pays its own tax.
How do we effectuate that?
There are certain rules spelled out in the Internal Revenue Code, section 671 to 679, which dictate what makes a grantor trust. And you have a grantor trust when the trustee can take certain actions with respect to the trust. For instance, if the grantor retains the right to swap assets of equivalent value, you have a grantor trust. If the trustee can make a loan to the grantor without adequate security or adequate collateral, it's a grantor trust. If income of the trust is accumulated for future distribution to either the grantor or the grantor spouse without the consent of an adverse party, you have a grantor trust. So these are things that have to be kept in mind when drafting a trust.
So there's, I think, what I would call in short order, some control issues there, some control metrics that are going to dictate whether or not it's a grantor trust. And so with the grantor trust, like why does anybody want to do a grantor trust, Adam?
Well, the benefit of a grantor trust is twofold. One, it's a little bit more flexible than a non-grantor trust because of those retained rights and controls, as you said. And two, and perhaps more importantly, because the grantor is paying the tax on the income of the trust can accumulate at a quicker pace. It can grow in value without having to pay taxes. And the payment by the grantor of the taxes is not considered an additional gift to the trust. Is
that why Congress, certain members of the Congress and the Senate may not appreciate this strategy?
You could say so. There's two proposals out there relating to estate and gift tax on one side and income tax on the other. Senator Warren's bill and President Biden's Green Book. And Kamala has basically adopted both proposals. So depending on what happens in the election and the Democrats' control of Congress, there could be a sea change in the treatment of grantor trusts. The proposals include provisions to basically provide that any grantor trust, it is not a gift to contribute to the trust, but the assets of the trust and all of the accumulation in value will still be included in the grantor's taxable estate when he or she dies. The proposal, however, does grandfather existing trusts.
So it's grandfathered in the past. So if you already have one, you're good?
If you already have one, you're good, as long as you make no future contributions or changes to that trust.
Oh boy. I bet a lot of people have future contributions in mind.
It could be a very busy November and December.
No doubt about that. So they essentially made it like an incomplete grantor trust.
In a way, the contributions would be not a gift. Any distributions to the beneficiaries would be a gift, and the assets would be includable in the estate.
So if you're thinking about doing one, and let's just say you're of a bearish mindset that this opportunity, this planning strategy goes away, then you'd have to, one, get a trust set up before it goes away. And two, what I think I heard you say is you got to max fund that thing because no additional gifts would qualify. Is that right?
Correct.
That's a lot. I don't think people are prepared for that.
It's a lot to take in. And the problem is we just don't know.
Yeah. So from a planning perspective, I want to make sure the audience gets the idea that as a grantor, you paying the tax is not a gift for that trust. And to your point, it accumulates faster. Oftentimes we refer to that as the burn because you get to pay the tax for the trust. Some clients get it and are happy to pay the tax. Some people don't like paying the tax. I think it's just a matter of explanation and goals and trying to set up the trust the way it's supposed to be set up.
That's right.
And one other thing we didn't talk about when particularly the grantor trust is from a charitable aspect. If you do a grantor trust, then that income tax benefit comes back to you. And so a lot of different ways to set up a grantor trust for your benefit and for the benefit of your family. If this legislation goes through, and I don't know when it would be, next year potentially, it's going to have a big one, you're not going to be able to get in touch with Adam. I mean, you will, but it'll be tough, right? It's going to be tough to find any estate planning attorney for that matter. But it's going to have such long-lasting repercussions. Like, what do we do with the ILETs that people are going to make additional contributions to, Adam?
Oh, that's a major concern. The way that the current proposals are drafted, it doesn't carve out an exception for a traditional ILA. So conceptually, take a client of moderate means that has their insurance policy held in an irrevocable life insurance trust, which is very standard planning. If the legislation passes, it could be that any future premium payments made on that policy would wind up invoking the legislation and mucking up the tax consequences and treatment of the trust. Two things that can be done immediately would be, one, structuring so future premium payments are done as a loan to the trust, or two, pre-funding the trust. Make a cash gift today of the funds needed to make the premium payments over the next number of years. But it is a major problem.
Not everybody has that money available, and that wasn't the plan they embarked on either. Could you convert it to a non-grantor trust?
Under current legislation and current tax treatment, the answer is yes. Under the proposed legislation, we just don't know how the treatment of decants are going to be. You may not be able to decant a grantor trust to a non-grantor trust without invoking some tax consequence.
Are they trying to make everyone's life hard here?
That's usually the job of the government.
Well, it keeps us busy, right?
Yeah.
So quite a bit of consideration there with the grantor trust, and I think what I would encourage people to do is to consult with your team and say, hey, I don't have one of these. I've talked about this in the past. Is now the time to do it, because this may be your last planning opportunity. Maybe not. I don't know. Nobody can predict the future, but it has been on the chopping block many times in the past. And as far as I know, the government needs the money. So they're probably going to enact something to put their hands on your money, I suspect. So you talked about a non-grantor trust. I just asked you, hey, could you convert it to a non-grantor trust? And under current legislation, yes. So I have this grantor trust that essentially is going to become not as helpful, let's put it that way, going forward. And so my option, to your point, is I either stack a bunch of money in there now, or maybe I decant this thing into a non-grantor trust. What's the advantage of the non-grantor trust, and why would that solve this problem?
Well, under the proposed legislation, there's no impact on the treatment of non-grantor trusts. So if you have a non-grantor trust, contributions to the trust are still gifts today, and the assets of the trust are outside of your taxable estate. So all of the traditional planning that we've been talking about, we don't expect any changes to the treatment for a non-grantor trust.
So why do they like non-grantor trust? Just the idea that you're not giving the free tax payment as a gift? Is that the whole reason they hate it?
The downside of a non-grantor trust, tax-wise, is that the trust is its own tax-paying entity, and it doesn't have the benefit of progressive tax brackets like an individual does. So the trust will hit the highest income tax bracket at all of $12,000 or $13,000 of income. Now, with a traditional insurance trust, it may not matter, because if the only asset of the trust is the policy, the trust isn't going to have any income anyway.
Correct. So I think you answered one thing in terms of like why would Warren want to get rid of grantor trust in the first place? One is this non-grantor trust pays the highest tax rate, starting at 12 grand, 13 grand, something like that. And there's no free gifting. And so do you think that there's going to be, obviously if they pass the legislation, this would be our option, but I'm starting to see more and more non-grantor trust put into play anyway. Are you seeing more of that?
I see a lot of non-grantor trusts, especially when it comes to state income tax issues.
How so, Adam?
Because a non-grantor trust is its own tax-paying entity. Contemplate a client that resides in New York, New Jersey, California, one of the high-income state tax jurisdictions. If you domicile the trust in a zero state income tax jurisdiction, Nevada, South Dakota, Delaware, Wyoming, Alaska. If the trust has assets and it either sells those assets or has income that is not sourced to a particular state, for instance, the sale of a business, the sale of stock, or membership interest in an LLC, because the trust is sitused in, say, Nevada, when the trust sells the intangible, there should be no or minimal state income tax on the sale. So the utilization of a non-grantor trust can have tremendous state income tax savings during the grantor's lifetime.
So for California, 13.3. I think we're set to go to 14.3 next year.
Yes, it's going up to 14.4 next year.
14.4. So
that's a big number.
Yeah, 14% on a big number is a big number, right? I mean, that seems obvious, but when you can save millions of dollars on a transaction by doing this type of planning, that's why people embark on this type of planning. So that used to be taken care of from Ing Trust. There used to be, we did some podcasts on Ing Trust. Ing Trust is still around. They don't really work in California. They don't really work in New York. Some other states have done some tweaks to nullify the benefits of it, per se.
We were talking about the income tax differences between trusts.
Mm-hmm.
From an estate and gift tax perspective, there's also two flavors. A completed gift trust, meaning the assets and value are outside of your estate, or an incomplete gift trust, meaning the assets are still included in your taxable estate. So one of the strategies that practitioners used is setting up an incomplete non-grantor trust. So it's an incomplete gift for estate and gift tax, but it's structured as a non-grantor trust for income tax purposes, meaning contributions to the trust were not completed gifts, so the valuation didn't matter. You weren't utilizing your exemption to fund the trust. New York in 2014 and California in 23 abolished the strategy effectively.
So now, I'm in California and you're in New Jersey doing a lot of work for people in New York. So it's only natural that we would pivot to more non-grantor trust strategies.
Correct. Now, in both states, you can still utilize a completed gift non-grantor trust, which is what we've been discussing.
So in a completed gift non-grantor trust, to your point, seeing it for the purposes of state income tax mitigation, and I think we're not going to have enough time today, Adam, and maybe we just do one on this, but there's a lot of complexity and things you need to be aware of such that you get it right to comply with each of the state's laws and how and their taxing authority regulations and things of such.
Right. Each state has its own rules as to under what circumstances the state can tax a trust.
What about fiduciaries? What if the fiduciary is located in that state?
It could be based on the residence and domicile of the trust fiduciaries. It can also be based on the domicile and residence of the beneficiaries. California, for instance, will tax a trust if the trustee is resident of California or if there are resident non-contingent beneficiaries.
So you threw out a super critical word there, Adam. Non-contingent. What's that mean?
Well, California takes the position that they can only tax the trust if the beneficiaries are non-contingent, meaning that they're entitled to distributions from the trust. Making a beneficiary a permissible discretionary beneficiary, meaning they can only receive distributions if, as, and when the trustee determines. So they don't have any entitlement to the trust. That makes them contingent, so California cannot tax unless and until a distribution is actually made.
Compare that to New York. Does New York have that?
New York takes the position that if a New York resident establishes a trust, all of the income of the trust is taxable to New York unless three conditions are met. One, all the trust fiduciaries must reside outside of New York. Two, the assets must be custodied outside of New York. And three, there is no New York source income. So if you have a trust, if a New York client sets up a trust, even if the trust fiduciaries are outside of New York, if the assets of the trust give rise to a penny of New York source income, New York will take the position that 100% of the income is taxable to New York.
Ouch. We're going to run out of time here. I think we're right over the target in terms of the considerations that people that are looking at this type of planning need to think about. And we covered some of the basics with, hey, why would you consider a grantor or a non-grantor? What are the advantages? Hey, grantor trust may go away, so you might want to consider talking to somebody about that. And what happens if it's not in existence? And then if it turns out that, hey, you should be considering a non-grantor trust, or how do you have to set it up to achieve your goals? Like, what are you really trying to do as a family? And if it's just state income tax mitigation on the disposition of a highly appreciated asset, that's one set of rules. If it's generation skipping, if it's charitable planning, whatever it is, you got to have the right team in place. And Adam, you're one of those people on our trusted advisor list that I have utmost confidence in, that I rely upon to help us navigate these issues with our clients. And so just personally, I want to extend a thank you for everything that you do for our clients. And
I appreciate that, Kyle. I really do.
RJ, we're gonna have to cut bait, I think, here. Unfortunately, I could continue on.
No, that sounds good. And how about some contact information? Adam, we'll go with you first.
And so my name is Adam Buchwalter. I'm a partner at the law firm Wilson Elser, based in the Madison, New Jersey office. My phone number is 973-735-5784. And my email is adam.buchwalter, B as in boy, UCHWALTER, @wilsonelser.com.
Excellent. And Kyle, your contact information?
Well, our phone number is 858-771-9500. And I can be emailed over at kmalmstrom, KMALMSTROM, @centurawealth.com. Or you could just, it's probably easier just to find Centura Wealth and contact us. And somebody will get back to you, and we'll touch base if you need to touch base. We'll figure it out.
All right, that sounds good. Kyle and Adam, thank you so much. And thank you for listening to the Live Life Liberated podcast with the team from Centura Wealth Advisory. If you have not subscribed to the podcast, please click the subscribe button below. This way, when the team comes out with a new podcast, it will show up directly on your listening device. And we humbly ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at Centura Wealth Advisory, I'm RJ Malik, reminding you to live your best day every day, and we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory. Centura is an SEC registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.